Good evening, everyone. Welcome to the online lecture on options and option strategies by Finstructor Mumbai. My name is Aditya Aluwalia. Hi again. Call me on 9833666920 for any queries or any clarifications you need about the online classes. Visit us at www.finstructor.in or call us on 9920222792 for more information on our products. We will begin shortly. In fact, if all of you can hear me properly, we can begin with the class on options and option strategies. Please say hi or say yes if you can hear me properly. Great, guys. Now, following up from what we studied in the last class, options are also a kind of derivative instruments. What are derivative instruments? These are securities that derive their value from an underlying asset or an underlying instrument. As discussed, that underlying instrument could be an equity, could be a fixed income security, could be your car, could be any asset. Futures and forwards, as we studied in the last class, were a right as well as an obligation for both counterparties. Once entered, the long counterparty was obligated to purchase the asset at the pre-decided price, and the counterparty who entered the contract as short was obligated to sell or deliver the asset at the pre-decided price. Now suppose I'm positive on the stock at a current price. Okay, let's take an example of any stock. So let's say Reliance. I have a view that there will be more natural gas in the KG D6 basin, or there will be more positive news flow coming for the stock. So I want to take a positive position in this counter. To take a positive or to execute my positive view, I have a number of options. First of all, for one, I could go and outright purchase the stock, just go in the cash market, pay the 1,000 rupees or whatever is the price of the stock and purchase the stock. I could also enter a futures contract. If I did not want to pay up the upfront money, I could enter the futures contract on Reliance as the long side, so that as the stock moves up, I gain from the mark to market and I profit on my position. Both these strategies do, however, expose me to a significant amount of downside risk. That is, the risk of my view or my understanding going wrong. So, if you're positive on Reliance, what can you do? Long the stock. Guys, long means buying the stock, okay? I will always use the term long and short henceforth. Long the stock in the cash market, that means just pay the money upfront and buy it. Long in futures market, that means only pay up the margin money, or if it's a forwards contract, not even the margin money, and you can enjoy the upside as the stock expires at a higher price than what you have locked in. However, both these strategies expose me to the downside risk. That is, if my understanding is wrong or if my view goes wrong and the stock actually corrects, the stock can go down in the worst case to a price of 0. I will lose all my invested capital. For investors who do have this positive view, want to execute a positive view on the counter, but do not wish to take so much of downside risk, there are instruments available called options. So an option entitles you to purchase or sell an asset, as we'll see the different types, at a pre-decided price, but not the obligation. So it gives you an option that you can purchase the asset at the pre-decided price or sell the asset at the pre-decided price. However, it's just an option for you. It is not an obligation. So you can exercise the option in case the price is higher and you have agreed to purchase it, or you have the option to buy it at a lower price. However, if the price is actually lower, you do not have the obligation to exercise it. So we'll understand in more detail type by type as to what options are and what exactly we mean by having the right but not the obligation. So the first type of option is called the call option. Call option gives the buyer of the option the right to purchase the asset at a pre-decided price. So let's say for the Reliance stock, I have an option, or I hold the option to purchase at 1,000 rupees. I have the right, somebody has given me the right to purchase Reliance at a price of 1,000 rupees. Actual price at expiration, or whenever I can get the opportunity to exercise this option, is rupees 1,200. Will I exercise my option? Will I exercise my right to purchase at 1,000 rupees? Yes, because the market price is 2,000 and the stock has moved up to 1,200. So I can purchase 1,000 and sell it in the market at 1,200. So I will make a 200 rupee or $200 profit. If the price actually is 800 rupees, will I exercise the option? That is, will I purchase from the counterparty at a pre-decided price of 1,000? The actual price is 800, so I will rather purchase from the market at the price of 800 than purchasing from this counterparty at a price of 1,000 rupees. So I will not exercise the option. So you understand the difference between going long or being in the futures or the forwards market than an option market. In case of a futures contract, I could have had a futures, longer futures to exchange the stock at a price of 1,000 rupees. However, the price went to 1,200, I would have had the same 200 rupees profit. If the price went to 800, I still was obligated to purchase the stock at 1,000 rupees. And I would have sold it for 800, so I would have made a loss of 200 rupees. Similar would have been the case had I outright purchased the stock at 1,000 rupees. I would have had to book a 200 rupees loss as the stock price corrected from 1,000 to 800. However, in the case of an option, I do not necessarily have to purchase the stock at 1,000 rupees. I can go and purchase it from the market if the price is corrected to 800 rupees. So, do you understand that for the holder of the option or the holder of the call option, there is now only an upside? If the price is higher, he will exercise it and he will receive the benefit. If the price is actually lower, he will not exercise it. He will rather go and purchase from the market. You understand, this is a win-win situation for the holder of the option. If the price is good, he'll exercise. If the price is bad, he will not exercise. To have this option or to hold this option, the seller or the counterparty who has written the option or who has given him the right to purchase from him at a price of 1,000 rupees, should he choose to, will charge an upfront premium. Upfront premium is also called the cost of option or the price of the option or the value of the option to begin with. So the seller will charge an upfront premium because he has given me this option. In later slides today, we'll understand how this premium is calculated, how much should the buyer be willing to pay. So you understand, unlike the futures contract where there was no upfront exchange of cash, in case of options, the buyer of the option has to upfront or immediately pay the seller of the option an upfront amount called the premium or the price of an option. So there is actually a buying and a selling happening in an option. So the writer of the option has given the buyer of the option the right but not the obligation to purchase the stock at 1,000 rupees from him should he choose to. When will the buyer actually choose to do that? When the actual price is higher than the pre-decided price. And this was about call options, guys. This was the discussion on call option. The second type of options are called put options, and there are only two types. The second type of options are called put options, which is the right to sell at a pre-decided price. Let's look at the same example again. Somebody has given me the option to sell Reliance to him or her at a price of rupees 1,000. When will I exercise? Let's assume the price actually moves down to rupees 800. Actual price is rupees 800. Will I exercise the option? Will I exercise the option to sell to the counterparty at 1,000 rupees? Yes, because in the market I can only sell in at 800. Remember, in the call option we did not exercise. We'll rather buy from the market at 800. In this case, we'll rather sell to the counterparty at 1,000 than sell in the market for 800. So the stock moves down to 800 rupees. The option will be exercised. Let's assume if the stock moves up to rupees 1,200. In case will I exercise the option? Will I understand the option? If the price moves up to 1,200, will I exercise this option? No. Because I would rather sell it in the market for a price of 1,200 than sell it to the counterparty for a price of 1,000 rupees. So guys, we broadly understand what the two types of options are. Again, for having the option to sell to the counterparty for a price of 1,000 rupees, the writer of the option or the seller of the option will charge an upfront premium. We will understand how that premium is calculated and we'll understand further concepts. So, to revise, options are a right but not the obligation. And let's understand some of the terminology that we are going to use in this chapter. Call option is an option to buy the asset at a pre-decided price. Please embed this in your minds. Call option, right to buy. Put option is the right to sell at a pre-decided price. Put option, right to sell. Delivery price is the price at which the buying or selling will happen. In the example that we discussed, the delivery price was 1,000 rupees or $1,000. It is also called the exercise price, as shown or as noted in the notations below. American options are options that can be exercised at any time before the maturity of an option. So if I give you an option that you can buy the stock from me at a price of 1,000 rupees within a period of 3 months. So an American option can be exercised at any time during those 3 months. Whenever I feel that the price is high enough, I can exercise the option, that is, exercise my right to purchase the asset and sell it off in the market or do whatever I like. So I can exercise the option at any time within the maturity of the option. European options can only be exercised at maturity. That means if the option is to buy the asset at 1,000 rupees, 3 months later, it can only be exercised 3 months later. So 3 months later, we will see the exact price. If the price is higher, the buyer of a call option will exercise it. Or if the price is lower, the buyer of a put option will exercise it. Again, we'll understand these concepts in more detail. We'll understand the payoff diagrams of both call and put options. The concept is going to become clearer as the class progresses. We will call capital K as the exercise price. We will call small c as the value of a European call option which can only be exercised at maturity, call option. Capital C as the value of an American call option. American call option, the right to buy at any point before the maturity. Small p will be notified as the value of a European put option. Capital P will be the value of an American put option. Now let's try to understand the payoff diagram on a long call position. So let's look at the same example. I'll change the price now from 1,000 to 100 for the sake of simplicity. So I have a call option at 100 rupees. Premium is 10 rupees. That is, to sell the option, the writer is charged an amount of 10 rupees upfront. This money will be traded upfront, regardless of whether I exercise or not exercise the money. This option is gone. It is paid to the seller as soon as I entered the contract. So the strike price is 100 rupees and the premium is 10 rupees. The question is, draw the payoff diagram under different under different spot prices at maturity. So it's a European option. It can only be exercised at maturity. Draw the payoff at different possible spot prices at maturity. The asset can end up at any price. It can end up at 100, it can end up at 120, it can end up at 90, it can end up at 0. So tell me, just to begin the discussion, if the price actually is rupees 120, compute the incremental payoff and total payoff for the buyer. Incremental payoff means excluding the premium. The premium is paid upfront, so I cannot, or it's a sunk cost, so I'm not going to talk about the premium when I'm talking about incremental payoff. Total payoff means including the principal. So if the price is rupees 120, will the holder of the option exercise it? He will exercise the option because he has the right to purchase it at 100, and now the price is 120, so he can sell it at 120 and purchase it at 100, so he can make an incremental profit of 20 rupees. However, he already lost 10 rupees premium upfront when he purchased this option from the writer, so his total payoff will be 10 rupees. So in a similar way, we are going to try and value the asset at different levels of spot prices. So let's assume this is the strike price of 100. So the x-axis is the spot prices represented by S. The y-axis is the profit. So tell me, at 100, if the spot price at maturity remains at 100, what will be the payoff for the total payoff? Okay, this is the total profit. What will be the total payoff for the buyer? So this is for the long party. He will be indifferent. He makes no money from the option because the spot price is 100, the strike price is also 100, so no payoff coming from the option incrementally. However, he has paid an upfront premium, so his total payoff will be a loss of 10 rupees. So he's going to lose 10 rupees on this asset. At a price of 80 rupees, if the spot ends at 80 rupees, what will be his total loss? Will he exercise the option? Will he exercise the option now? He has the right to buy at 100, but in the market stock is available for 80. Will he buy from the market at 80, or will he buy from the counterparty at 100? He would rather buy from the market at 80 rupees, so the option will not be exercised. If the option is not going to be exercised, that means you will lose your initial upfront premium. So you already paid the premium, you will lose that premium. So notice, at any point below 100, if the stock remains below 100, the option will not be exercised. The buyer of the option is going to lose his premium. So he will have a loss of minus 10. Now let's understand what happens as the stock starts moving up. So let's say the stock ends up at a price of 110. So the stock price is 110. Will the option be exercised? Yes, because he can sell it in the market. I understand the total profit will still not be there for those of you who are thinking like that. But he has the option to buy it at 100, and now the market price is 110. So he will make a 10 rupees incremental profit, which will help reduce his upfront cost. So he will make a 10 rupees profit, which will entirely be eaten up by the 10 rupees premium that he had paid upfront. So his overall payoff is going to be 0 rupees. If the stock moves up to 120, we discussed earlier that he would be able to realize 120 by purchasing the asset for 100 and selling it in the market for 120. So he would receive a 10 rupees profit, 20 rupees profit. However, 10 rupees is the original premium that he had to pay. So his total profit will be 10 rupees. So guys, understand, for every 1 rupee further increase over 100, the buyer's payoff is going to increase by 1 rupee. So as the stock price keeps moving up, this is exactly a 45-degree line. This angle is exactly 45 degree. Why? For every 1 rupee up movement in the stock price, there is a 1 rupee up movement in the profit. 1 rupee movement here means a 1 rupee increase in profit. So it's a 45-degree line. This is the payoff on a long call. So the long call position benefits as the stock price goes up, with the added advantage that it does not lose as much if the stock price falls. The worst case loss for a long call position can be the premium. So this premium is not really a very small amount. It is a fair amount, and in the worst case you can only lose the premium. Even if the stock goes down to 0, you can only lose the upfront premium. Take a look at the slide and please verify if this is how the payoff for a long call would look. So the thin line is the incremental payoff. The dark bold line is the overall payoff. So the overall payoff will be $10 lesser than the incremental payoff because the upfront premium is going to be deducted from it. So let's look at the formula given. That is the value of a call option. Rather, I'll call it the incremental value of a call option will be given by the maximum of spot price minus the strike price, or 0. So the incremental value will be 120 minus 120 in case the stock ends at 120. If the stock ends at 140, the incremental value will be 40. So you agree that the incremental value will be the spot price minus the strike price. What will be the total payoff? The total payoff will be the incremental value minus the premium. We will do this many times, guys. We will do this for short call, short put, long call position, so you'll understand this. Long call is an option to buy the stock at a pre-decided price of $100. Let's look at how the payoff would look on a long put position. Let's look at how the payoff would look. Please take 1 second, everyone in your notebooks, try to draw the payoff on a long put. I will draw it in 1 second. Just try to think about it for 1 second, and I'll draw it thereafter. So a put option is an option that gives the holder the right to sell the asset at a pre-decided price. So put option at 100 rupees, which is the right to sell at varying levels of the spot price. Please try to compute the payoff. Please try to draw the payoff. Take your time, guys. Take 1 second to think about how it's going to look. So let's see. The same. The price of the option is the same hypothetically. So to buy that option, he also has to pay 10 rupees of premium. Let's understand, if the stock price is at 100, what will be his position? What will be the profit or loss for the holder? Okay. Again, I'm doing it for the long put. Total payoff. Total payoff for the long put. He has the right to sell it at 100 rupees. If the stock ends at 100 rupees, he would be indifferent whether he sells it to the counterparty or he sells it in the market, because the spot price is also 100. So his total payoff will be the loss of the upfront premium. So if the stock price remains at 100, he will just lose his upfront premium of 10 rupees that he had paid. Now let's assume the stock ends up at 120. He has paid 10 rupees to have an option with him to sell the stock for a price of 100 rupees. Will he exercise the option? Will he sell the stock to the counterparty at 100 rupees or will he sell it to the market at 120? He'll sell it in the market at 120, so the option goes unexercised. So the option goes unexercised. If the option goes unexercised, what does that mean? That means he loses his premium. So again, 10 rupees he will lose. In fact, for any price greater than the spot price, if the price is above 100, the buyer of the option will lose the upfront premium amount as he will not exercise the option. So he doesn't have to buy it at 100. He will buy it if he likes to. When will he like to? When the price is actually lower. Now let's say the market ends up at 80 rupees. So if the market is at 80 rupees, that means in the market if he goes about selling the asset, he will only fetch 80 rupees. However, he has an option to sell it to the counterparty for 100 rupees. Will he exercise the option and sell it to the counterparty? Yes, he will. So his incremental payoff will be 20 because he's selling it to the counterparty at 100 and he will be able to buy it from the market at 80. So he gets an incremental payoff of 20 rupees. However, 10 rupees will be eaten up by the premium that he had paid upfront, so his total profit will only be rupees 10. If the stock price ends at 90, will he exercise the option? Yes, he still will exercise the option because he can sell it to the counterparty at 100 and he can buy at 90. So he will sell it at 100, buy it at 90 and make 10 rupees of profit. However, 10 rupees is also the premium that he paid, so incremental profit is just 0. Again guys, this will be a 45-degree line. For every 1 rupee fall in the stock price, the profit or the payoff will increase by 1 rupee. As the stock falls to 79, 76, 0 in the best case for the holder of the put option, his profit will keep moving up. Let's take 1 minute guys now. Try to draw the payoff for the short parties. Try to draw the payoff for the short call and the short put. But before that, let's see and let's verify if this formula is correct. So it says that the payoff or the incremental payoff excluding the premium on a put option is given by maximum of K minus ST, 0. That is the difference between the strike price and the spot price. So in case the spot is at 80, he will make a benefit of 20 rupees. So if I have to calculate the total payoff, it will be max of K minus ST minus the premium amount. So for call option, the incremental payoff is max S minus K, 0. So there can only be profit. Incrementally, there can only be profit, or the value will be 0. You will never make a loss. You will simply not exercise the option if it is not favorable for you. In the worst case, in both the call option and the put option, the loss can be equal to the principal value. So the worst case loss is equal to the principal value. Please take a second and try to think about how the payoff will look on a short call position and a short put position. So a short call position has given someone the right to sell to him, rather the right to buy from him at a price of 100 rupees. So if the buyer chooses to exercise, the writer of the option will have to sell the asset at a price of 100 rupees. That is for the call option. Let's look at the payoff on a short call position. Short call is the right, or you have given someone, so for you it will be the obligation to sell the asset at a pre-decided price should the buyer choose to exercise the option. So let's say the stock price remains at 100. The stock price remains at the original strike price. Will the buyer exercise it? Will the buyer of the call option exercise it if the spot is equal to strike? He's indifferent. He'll rather sell it he'll buy it from the market also at 100. You are also selling it to him at 100. So he's indifferent. So the seller of the option will enjoy the upfront premium that he received. So he will have a profit of 10 rupees. In case of the call option, if the spot price remains below the strike price, so let's say the option short call is the writer of the call option. Somebody has bought a call option, somebody will have to sell it to him, he can't buy it without a counterparty. So the holder of the option must have a counterparty who has sold the option to him, who is going to, what is the call option? Call option is the right to buy. If someone has the right to buy, there has to be a counterparty which has the obligation to sell. The seller of the option or the writer of the call option, writer, seller mean the same thing, is the short position, is the short party. He has agreed to sell the asset to the buyer of the option at a pre-decided price of 100 rupees. For selling that option, he received an upfront premium. If the stock price remains at 100 rupees, the buyer of the option will not exercise the option. So the seller will be very happy. The seller will enjoy his upfront premium of 10 rupees. You understand? At this point, he is enjoying the upfront premium of 10 rupees. If the stock price moves down to 80 rupees, let's say the stock price moves down to 80 rupees, will the buyer exercise the option? Remember, the right is with the buyer. So the seller will have to do whatever the buyer desires of him. If the stock price actually goes down to 80 rupees, will the buyer buy from this guy at 100 or will he buy from the market at 80? The spot has moved down to 80. Will the buyer of the option buy from him at 100 or buy from the market at 80? It's a call option and the stock has moved down to 80 rupees. He will buy from the market at 80. So he will not exercise the option, he will buy from the market at 80. So the seller is very happy. He will continue to enjoy his 10 rupees premium because the buyer is not exercising the option. So for all instances where the spot price is less than the strike price, the seller of the call option will enjoy the upfront premium because the buyer is not doing anything, so he doesn't have to do anything. As the stock price moves up, the stock price moves up to 110. Will the buyer now buy from this guy at 100 or will he buy from the market at 110? Will he buy from the seller? He will now buy from the seller as the price moves to 110. So the seller will have to sell to him at a price of 100. So seller will sell, or the short party will have to sell to the buyer at a price of 100. How much is he purchasing the asset for? Now what is the market price? 110. So he is purchasing the asset for a price of 110 and he is selling to the buyer of the option or the holder of the option at 100. So what is his loss? 10 rupees. His loss is 10 rupees, but he received an upfront premium of 10 rupees. So his total payoff will cancel out to 0 rupees. Guys, tell me the incremental payoff and the total payoff for the seller if the stock price moves up to 150 rupees. So I have given someone the option to buy from me at a price of 100, or I will have to sell at a price of 100. If the stock price moves up to 150, what will be my incremental profit or loss, and what will be my total profit or loss? So incrementally the buyer will buy from me at 100, I will have to sell it to him at 100, and I will buy from the market at 50. So my payoff will be minus 50, or my loss will be 50 rupees incrementally. I am buying at 150 and selling at 100. But I received an upfront premium of 10, so my total loss will only be 40. The stock price can go up to an infinite value, it can go up to a very high value, so my loss in this position can be infinite. My profit is capped by my premium. So guys, make sure when you price the option, you take enough of a premium to begin with such that this big risk is captured in the premium amount, or the seller will charge a good premium such that it covers his risk of the stock price going up to a very high value in case the events are favorable for the stock. So the downside is infinite. So the buy long call or the sell call will always be exactly minus the payoff for the buyer, or the long call will be minus the payoff for the seller or the short call, and vice versa. In all derivatives, guys, for all derivatives, the long party will have the exact opposite payoff as the short party. Let's understand the payoff. That's correct, it's a zero-sum game. Let's understand the payoff for a short put position. In a put option, I have given the holder or the buyer of the option the right to sell the asset to me at a pre-decided price of 100. So I have sold the right to sell the asset to me at a pre-decided price of 100. I have given someone the right to sell to me at a price of 100. I have charged an upfront premium for that, but he still holds that right. When will he exercise that right? When the actual price is lower, he will sell it to me at a pre-decided price. If the actual price is higher, he will go and sell it in the market. Why will he come to me? So let's look at the fourth chart in front of us. The strike price is 100. If the spot price goes up to 150, will the buyer or the holder of the option sell the asset to me at 100, or will he sell in the market for 150? He'll sell it in the market for 150, so the option will not be exercised. If the option will not be exercised, as a seller of the option, I will enjoy my upfront premium. So for any price equal to or greater than 100, as a seller of the option, I don't come into play at all, or I don't have to do anything, because the buyer or the holder will not exercise. Remember guys, the seller has the obligation. He has to do the other side of whatever the buyer has the right. So he has to take the other side. For all instances where the spot price is greater than 100, the seller of the option will say, why sell to him at 100? I'll rather sell in the market. If the stock price falls down to 50 rupees, the buyer has the right to sell to me at 100. Will he exercise that right? The stock is actually at 50 rupees. Will he exercise the right to sell to me at 100? So he can buy in the market from 50 and he can sell it to me at 100. He gains 50 rupees. Or in other words, I will have to buy from him at a price of 100 since I have the obligation. I will have to buy from him at 100. And what is the market price now? I can sell it only at 50. So what will be my incremental loss? 50 rupees. But I received an upfront premium, so my total loss will be 40 rupees. So my total loss is 40, my incremental loss is 50. As the stock price keeps moving down, I will have more and more loss because I will buy at 100 and sell at a lower price for the seller. So again, these are all 45-degree lines, guys. All inclined lines are 45-degree lines in this curve. Because of the limited liability clause in financial markets, that is, the stock can at worst go down to a value of 0. It can never go down to a negative value. The worst case loss for the seller will be equal to the principal minus the, or rather the strike price minus the premium. So it is not an infinite option, or it is not an infinite loss as it is not an infinite loss as is the case of a call option. Guys, whoever has the right to execute will be called the buyer of the option because he will have to pay an upfront premium. Whoever gives somebody the right will be called as the short position or the seller of the option, because he will receive the upfront premium. Now the option can be to do anything. Option can be to buy the stock, sell the stock, to double the stock. I can have whatever option. If I am giving the option, I am the seller. If I am having the option with me, I am the buyer of the option. So guys, we understood a very important concept. We understood the payoff diagrams on calls and put options. Now we'll understand a very interesting concept called the put-call parity. Okay. Later on in today's class, we'll understand how to value, or how does the seller decide what premium should I charge. I'm giving this guy an option. Should I charge 100 rupees? Should I charge 10%? Should I charge what price? So please just hold on to this. We haven't studied valuing options right now, but let's assume we know the prices. That is, to buy a call option, like the 10 rupees I had told you, we know the prices of the call options and the put options. Let's try to derive a very interesting ratio. So guys, see the two portfolios on the slide in front of you. Okay, how did I think of these portfolio? I just dreamt of it. This is just one way of proving the put call parity. It can be proved in many ways. Before I prove the put call parity, let me revise the no arbitrage principle that I did in the first class. The no arbitrage principle said that two assets delivering the same payoff must have the same price. So there is an asset A which is expected to give me 100 rupees 1 year later. There is an asset B which is also expected to give me 100 rupees 1 year later. On both assets there is absolutely no risk. So it is 100% sure that both A and B will give me 100 rupees. There is no risk. There is absolutely no concern. What will be the price that I will be willing to pay for A and B? No arbitrage principle says that you will be willing to pay an equal price for A or B. Otherwise, there will be an arbitrage opportunity. Whatever is the PV, that is correct. You will pay the PV, but that PV has to be the same, because both are giving the exact same amount of money. So if A is more expensive, a simple way to make riskless profit will be short A and long B if A is greater than B, because both are giving you the same payoff of 100 rupees. So just understand this, guys, that if two things are giving me the exact same benefit, which is for sure, there is no risk, there is no uncertainty, then I will be willing to pay the same price for them to begin with. Okay, also called the law of one price. Now let's understand two portfolios. Portfolio 1 is buying a call option, selling a put option, and investing at the risk-free rate. So in portfolio 1, I bought a call option. Both are European options. European options means they can only be exercised at maturity. I sold a put option and I invested some money at the risk-free rate. If I buy an option, do I have to pay the upfront premium or do I receive the upfront premium? All cash outflows from my portfolio are represented as negative. All cash inflows into my portfolio are represented as positive. So because I chose to pay the premium, it will be represented as a minus C. If I sell a put option, do I receive the premium or pay the premium? I receive the premium, so it will be represented as plus P, or I will receive plus P. If I invest K e raised to power minus RT, and don't tell me how I thought about K e raised to power minus RT, I just dreamt of it, okay? If I invest K e raised to power minus RT in a bank, it will be represented as minus K e raised to power minus RT. So I have a portfolio in which I bought a call option, sold a put option, and invested K e raised to power minus RT in a bank. Okay. So let's understand. Buy a call, sell a put, invest K e raised to power minus RT in a bank. Now let's understand that at maturity, what will happen to this portfolio? At maturity, or when the expiration comes, there are two possible scenarios. That the spot price is greater than the strike price, or the spot price is less than equal to the strike price. If the spot price is greater than the strike price in the first case, what will be the payoff on the call option? I have bought a call option at a strike price of K. What will be the payoff on the call option? S minus K, because S is greater than K, so I will buy the asset for K and I will sell it in the market at S. So my total payoff will be S minus K. On the put option that I have sold, if the spot price ends up to be greater than the strike price, what will be the value of the option? If the spot price is greater than the strike price, will I exercise the option? Will I sell it in the market for S, or will I sell it to the counterparty at K? I have sold a put option. So will the buyer of the option exercise this option if S is greater than K? No. So I've received the upfront premium, which is fine. There will be no incremental payoff. If I invest K e raised to power minus RT in a bank at a time T later, or at a time T from now, I will receive K rupees back. So please compute the total payoff from this portfolio if the spot price is greater than the strike price. Total payoff will be S. Let's understand, if the spot price is less than or equal to the strike price, will the total payoff, what will be the total payoff? The spot price is less than or equal to the strike price. So will I exercise the call option? Will I buy from the market at a lower price, or will I exercise? I will not exercise the call option because the spot is greater than the strike. So no payoff from the call option. Understand, guys, when a call is having a payoff, a put can't have a payoff. And when a put is not happening a payoff, normally the call will have a payoff. I have also sold a put option and the spot price is actually lower than the strike price. Will the buyer of the option sell it to me at K and buy from the market at S? Is this the profit for the buyer? This is the profit for the buyer, K minus S. You have sold the option. You will have an exactly equal loss. You will have a loss of K minus S because the buyer of the option will execute the option. He will buy from you buy from the market at S and sell it to you at K. He has the right to sell to you at the price of K. You invested K e raised to power minus RT in a bank. At maturity, how much will that mature up to? It will mature up to a value of K. So what is the total payoff that you will have in case the spot price is less than the strike price, less than or equal to the strike price? It will still be S. So we understand that from the first portfolio, that is buying a call, selling a put, investing K e raised to power minus RT, that is the upfront cost. CP, don't worry, we are only worried about the incremental. That is gone, some cost initially gone. So the total payoff will be S, whatever is the spot price now. So the incremental payoff from both, the incremental payoff at maturity from both will be S. Does everyone understand that? That the incremental payoff from, in all circumstances, from this portfolio will be S. Now let's Now let's look at the second portfolio. In the second portfolio, I just purchase the asset or whatever is the price today. Just go ahead and buy the asset. If you buy the asset, you will have to pay the stock price. Whatever is the price, you pay it and you purchase it in the stock market. At maturity, what will be the value of the stock, or what will be your value of your portfolio? It will be the stock price at maturity. So do you understand that both these portfolios, both portfolio 1 and both portfolio 2 are giving you ST at maturity? Portfolio 1 is also giving you ST, portfolio 2 is also giving you. By the no arbitrage principle, if two portfolios are giving me the exact same payoff at maturity, I should be willing to pay the exact same price for them to begin with. So I should be willing to pay the exact, how much price do I have to pay for the first portfolio? I bought a call option, so I have to pay minus C. I sold a put option, so I received a P, and I invested K e raised to power minus RT, so I had to pay that much money to a bank. This combined gives me a payoff of S. Another thing that gives me a payoff of S is buying the stock. So if I just purchase the stock, I still receive a payoff of S. The costs have to be same. This derives one of the most important relationships for the FRM and also the CFA exams, called the put call parity, guys. You will memorize this by heart, okay? In your sleep, this formula should come out from you. I'll just rearrange it in the format that I like to remember it. Take the C and P that side and bring the S this side, okay? So formula will become C minus P is equal to S minus K e raised to power minus RT. That is, the price of a European call option minus the price of a European put option is equal to the spot price minus K e raised to power minus RT, where K is the strike price and T is the time to maturity of the options. T is the time to maturity of the options. The option matures in 1 month, 2 months or 3 months, however it is. You will do a few examples of this formula, other many examples, and concretize this concept. C minus P is equal to S minus K raised to power minus RT. Now this has far-reaching applications, guys. There are many complicated problems that I'm going to teach you some proprietary shortcuts on how to do using the put call parity. So try to read the first question and I will tell you a shortcut method of solving it. Think for a second and try to answer it, and then we'll understand the shortcut from the put call parity as to how you'll solve it. Okay, your book goes a very roundabout way in solving these questions. So tell me, according to the put call parity, writing a put is like A, B, C or D. Take a second to think about it, and then I'll tell you how to solve these type of questions. So guys, understand the convention. Writing an option means you are selling the option, means a cash inflow. It means plus P. Cash inflows are represented as positive. Writing an option is plus P, okay? Buying an option means I have to pay the cash upfront, I have to pay the premium, so it will be represented as minus P. Similarly for call options, plus C and minus C. Okay, I'll do one question, I'll ask you many such questions, okay, and you'll understand with practice. So he's asked, writing a put will be represented as plus P. So rearrange this formula to get plus P on one side. What will plus P look like? It will look like C, or I'll just write it plus C minus S plus K e raised to power minus RT. Okay, rearrange it. He asked me writing a put, so I got plus P on one side. Plus C means what? Buying a call or selling a call? I'm receiving the premium. Again, Chandravan, I'm receiving the premium plus C. I have to write the call. write call or sell call. Minus S means what? I have to pay S. I have to pay S when I buy the stock or when I sell the stock? Buy the stock. Plus K e raised to power minus RT. It's a cash inflow again, means I'm borrowing or lending. Plus K e raised to power minus RT. I'm getting K e raised to power minus RT from somewhere. Am I borrowing or lending? So writing a put is like writing a call, buying the stock and borrowing. Understood, guys? How you have to do it? You have to first rearrange what you need and then solve the question. So we'll do a couple more and please answer and understand the concept. So now tell me, shorting a stock is like, using the put call parity, shorting a stock is like. Okay, do the same way. Shorting a stock will be represented as plus S or minus S. You are selling the stock. So it will be represented as plus S. Keep plus S on one side. Rearrange the equation to calculate how plus S looks like. C minus P is equal to S minus K e raised to power minus RT. Plus S will look like S is equal to C minus P plus K e raised to power minus RT. So plus C will look like buying a call option. Minus P will look like, I'm sorry guys, see again even I'm making a mistake. What will plus C be? Plus C will be buying a call or selling a call? It's a cash inflow, writing a call. Good. Writing a call. Minus P will be buying a put. And plus K e raised to power minus RT will be borrowing. Borrowing at the risk-free rate. So shorting a stock is equivalent to writing a call option on the stock, buying a put option on the stock and borrowing at the risk-free rate. This is called a synthetic position. Instead of shorting a stock, you could have created a synthetic short stock position by doing the equation on the right side. Do one last, guys. Investing at the risk-free rate is like. Question asked is, according to the put call parity, investing at the risk-free rate is like. Investing at the risk-free rate is like, please answer the question. I'll tell you when these synthetic positions are used. Again guys, very quickly, C minus P is equal to S. Investing will be like how? Is it a cash inflow or outflow? It will be represented as minus K e raised to power minus RT because I am investing. So it's a cash outflow from my portfolio. C minus P is equal to, just one of this question is going to come in the exam. I'm very confident. So keep minus K e raised to power minus RT on one side and take the others. So it will become C minus P minus S is equal to minus K e raised to power minus RT. So plus C is again like writing a call, minus P is like buying a put, and minus S is like buying the stock. So write a call option, buy a put option and buy the stock. You would have created a risk-free position. You would have created an investing at the risk-free rate. Understand guys? Minus S is buying the stock, not selling the stock. So now understand, there is a foreign investor who likes the interest rates in India. Okay, he likes the 10% rates that most banks are giving. Even government bonds are giving an 8.7% rate of interest. However, he was not allowed by the regulatory norms to invest in the bond market or to buy government debt. He wants to take an exposure at the risk-free rate. He wants the risk-free rate, but he can only invest in the stock markets. He is not allowed to invest in the bond markets. How can he create that exposure? He can create by writing a call on the Nifty, buying a put, and buying the underlying Nifty index. Or any stock he can do or he can use the futures or the options on any stock to create a synthetic risk-free position. So you understand, when the underlying market for the asset is not very liquid and the market for options is more liquid, or the underlying for the stock is more liquid, you can use a synthetic position. Also, if the assets are not consistently priced, that is, a call option is not priced according to the put call parity, you can use the synthetic position to benefit from the arbitrage opportunity. That is, in the synthetic market it is available cheap, actually it is available expensive. So long in the synthetic market, short in the actual market. Many ways, many uses of the synthetic positions. Okay guys, let's do the second question now. That's a little calculation based. Please get your calculators out. Please read the question and try to solve it. A 2-year European call option. A 2-year European call option A 2-year European call option has a market price of $50 with a strike price of $140. The underlying stock price is $100. I will explain it again guys, it will keep coming again. With a 2-year annualized interest rate of 5% and a dividend yield of 2%. What is the number closest to the market price of a 2-year European put struck at $140? I can rephrase this question is, compute the price of a European put using a synthetic position. So the put call parity says that C minus P is equal to S minus K e raised to power minus RT. A synthetic position in the put can be created by taking the put on one side. It can be created by plus P, or short put. It can be written as C minus S plus K e raised to power minus RT. In the question, what is the price of a call option? Call option has a market price of 50. What is the stock price? Underlying stock price is 100. What is the strike price of the options? Both strike price of both the options have to be the same. Strike price is 140. E is E. E is 2.71. Press 1 on the calculator and press second and E. Press 1 on the calculator, then press the button second and press ln. You will get the value of E. What is the value of E? Please write down. Press 1, press second and press E. Tell me the value of E. 2.71. That's correct. Okay. Chandraman, have 5 decimal places on your calculator, please. Okay. Please give me the answer in at least 3 or 4 decimal places. Okay. So please do e raised to power minus RT. That is, first calculate the rate of interest. I'm sorry guys. the asset also has a dividend yield of 2%. Okay, the asset has a dividend yield of 2%. The formula that we derived was for non-dividend paying stocks. Understand, for stocks that pay dividend, replace S by S e raised to power minus RT. Always remember, from futures and forwards I'm borrowing this concept. Whenever the asset has a dividend yield of R star, replace S into S e raised to power minus R star T. If it is a discrete dividend, do S minus the present value of dividend. That's correct. Okay. S e raised to power minus R star T minus K e raised to the power minus RT. In case of a discrete dividend, you can reduce the present value of the dividend. C minus P is equal to S e raised to power minus R star T. And expected to perform all consistently priced. Buy a call option. So the buy call position will benefit when the stock price goes up. So he can't